Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hello, welcome back to the Investing Podcast, put on and presented by Tusk Media. I'm Ben Nye, and today I wanted to talk a little bit about the economic state of affairs in the United Kingdom, especially post-Brexit. So, as we all know, last summer, the UK voted to leave the European Union. They were never a part of the Eurozone, but they wanted to leave the European Union single market. And a lot of the rationale for that was that because they wanted to make their own trade deals, and they didn't want to be held hostage to Brussels, continuing to pay money to a lot of bureaucrats, quite frankly, and that's kind of that's how the populace voted. And now we're in this state of affairs where the UK is looking to now actually act upon the Brexit. Obviously, it was voted on. Some people don't think that's actually going to happen. That's the state of affairs at the moment. At the time, there were a lot of doomsayers. If the UK leaves the European Union, they said that it was going to plunge the economy into recession. And I think that a lot of those doomsayers actually got caught out because they didn't actually have the gloom and doom that everyone was predicting. So when you forecast something that doesn't happen, all of a sudden you start to lose credibility. And I almost think that actually played a role in Trump actually winning his election, because all of a sudden people realize that, you know, what everyone's trying to scare us with, that actually isn't coming true. So it emboldens the public to make more radical decisions from the voting booth. So today I wanted to go through a few charts. I think we have 9 of them, and we're going to go through them pretty quickly, but you can always pause the video if you want to look at the chart in a little more detail. The first few are the economic surprise indexes. So Citigroup, they put out an economic surprise index, which basically says where is the data coming in, the high frequency economic data like the jobs report, GDP reports, PMI reports, purchase and pension index reports. Where is that data coming in relative to what the street consensus thinks? And if the surprise index is high, it means that things are better than the street has been anticipating. And usually you see this kind of hover around 0. Ideally, you know, if the analysts are doing their job right, you should see it about 0 almost all the time, because the street's accurately predicting what the data is coming in as. You notice when the street is wrong if there's a big high or a big low. So what we've seen that's been particularly remarkable in the last 3 to 6 months is that the economic surprise indexes across really all Western economies are better than expected, and by a significant margin too. So first up we have the US. US economic surprise index, not egregiously high, but definitely noticeably high. We've had a few jobs reports that are better. And the ISM numbers, the Institute for Supply Management, those numbers are coming in better than as expected. If you remember back about 6 months ago, you had the ISM Manufacturing Index dip below 48 and continued to drift lower even than that. And the problem with that was that people look at the ISM and say, well, when the ISM gets below 48, we've had a recession X number out of Y number times. And that probability obviously increases until you get down to about 45, 44, and then you're talking about like 80, 90% of the time, you get a recession when you have that situation. So people were concerned about that. They were really looking at those indexes, and they were projecting forward future economic woes and malaise, especially with the political situations in the UK and then the uncertainty in the US. However, what we've seen in the US is that the economic data has actually surprised to the upside. So that's good in the U.S. We see a similar thing in the Eurozone. So this next chart shows the Eurozone Economic Surprise Index, again similar to the U.S. in terms that it's beating expectations. You can see in February, when everything was collapsing, that's when everyone thought Deutsche Bank was going to go bankrupt, that its massive notional derivative exposure was not hedged the way that they thought it was going to be, and that it is over leveraged. And I still don't think that you've seen Deutsche Bank completely address all those concerns, but the market has become more comfortable with those concerns, and I think that they can be a little bit of a muddle through. Maybe they'll have to have some more state aid, but I think that state aid will come in just as it did for Monte Paschi in Italy a few weeks ago. The last one is probably the most noticeable, and that's the UK. And you can see here just the extraordinary amount to which the UK is now beating expectations. The street is definitely behind on the UK. It's not pricing in the same bullishness in the data that we're seeing out of the UK, and the street is struggling to catch up. So what you'll see probably, these things don't last for a long time, because then as the data improves, then all of a sudden analysts start to jump over themselves in order to try to get out ahead of the next data point. So you can see them overcorrect. So I would expect that to happen in the next 3 to 6 months or so, maybe even sooner than that. Now, a lot of people like to say, well, are these correlated to stocks? And unfortunately, you can't really exactly portray this onto stocks and say, well, this is a good leading indicator for stocks. It is a coincident indicator. I would say look at it more correlated to bonds. I mean, obviously, you can run the correlations. It's a simple Excel formula, so you can figure that out. And if you notice, if you look back at the Eurozone surprise index, you can see that bottom just about when the bond yields were bottoming. So you can start to map across the data to actual hard money in that way. So what has actually been doing better than expected in the UK? Well, we addressed the US ISM earlier in the podcast today, but I also wanted to talk about the UK ISM because the December data was particularly notable. We're seeing an acceleration first in the manufacturing data, which was released earlier, but then secondly in the services data. This suggests that companies are becoming more bullish on the UK economy and are building more, and orders are picking up and inflation is picking up. And that's a bullish sign for the UK economy and could result in interest rate rises that are faster than the street expects, especially in the UK, where Carney has said that he will be slower in light of the Brexit and the potential risks that poses. So both manufacturing and services PMIs have been better than expected and accelerating to the upside. So that's real positive for the UK economy. You can also see this exacerbated in stock prices. If you look at Barclays, for instance, you see the bottoming process that it had over the summer and into the fall, and now it's significantly higher. If you had bought in the few days after Brexit, you would be doing quite well. Similarly, RBS, you're now seeing it break above 550. That was a big point of resistance before. They do have some concerns and some things that they need to address with the Bank of England, but I think a lot of those concerns were brought up at the end of 2015 and beginning of 2016. So in that time, RBS has made more progress, and I think when you get the next update from the Bank of England and the regulatory authorities against RBS, I think you'll start to see some of those concerns mediate a little bit into the rear view mirror. Not completely. These things take a long time to change, especially when you're dealing with this much leverage. But I think that especially if the UK economy can improve, that RBS's situation is better than expected. But what's interesting is that I still think that economists are well behind what's actually going on in the UK economy. You're seeing ISM now significantly above 55 on both the manufacturing side and the services side. That's a very bullish sign for the economy. But if you look at the UK GDP, the estimate for 2017 is still well below what the estimate was prior to Brexit. I think that until you see overheating in the analyst estimates, you need to get that 2017 GDP estimate higher. Maybe not to where it was prior to Brexit, but definitely a lot closer than it is now. We're about halfway the way back for analyst forecasts. So keep an eye on that. Also keep an eye on the British pound. What's interesting is that the British pound has not strengthened. We saw what happened with RBS, we saw what happened with Barclays, we see what's happening with the data, but the British pound is still depressed relative to the US dollar. If the UK economy does accelerate, I think there's more running room, especially as the US starts to process some of these reforms that the new administration is bringing in. So the UK economy could actually accelerate faster than the US economy. I'm not saying necessarily grow faster, but it could have more acceleration, which would be good for asset prices and probably good for the British pound versus the US dollar. And almost certainly good for the British pound versus the euro. So keep an eye on that. Keep an eye on what's happening in the UK. There's not a very followed story because Trump is taking all the headlines and all the Twitter bandwidth. So there's just not as much room to be written about what's happening in the UK economy. But keep an eye on it. It's a big story and could be one of the more underrated stories for 2017. This has been the Investing Podcast. Thanks for watching or listening. And always hit us up with questions on Twitter, Seeking Alpha. And stay tuned for next week. Thank you.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.